What if I told you that the biggest economic accusation of the 21st century might have been completely misunderstood? For decades, politicians and economists have been throwing around claims that China has been manipulating its currency to gain an unfair trade advantage. But here's the thing that's going to blow your mind. The actual data tells a completely different story than what you've been hearing in the headlines. I've spent the last month diving deep into Treasury reports, Federal Reserve analyses, and economic data that goes back 20 years. And what I discovered is going to change everything you think you know about currency manipulation, international trade, and the real forces shaping our global economy. By the end of this video, you're going to understand exactly why this accusation has persisted for so long, what the evidence actually shows, and why getting this wrong could cost the global economy trillions of dollars. But first, let me ask you something. Have you ever wondered why your iPhone costs what it costs? Or why certain products seem impossibly cheap while others feel overpriced? The answer lies in a complex web of currency relationships that most people never think about, but that affects every single purchase you make. Currency manipulation isn't just some abstract economic concept that only matters to Wall Street traders. It's the invisible hand that determines whether your dollar stretches further or falls short, whether American companies can compete globally, and whether entire industries thrive or collapse. And when we're talking about the world's two largest economies, the stakes couldn't be higher. So let's start with what currency manipulation actually means, because this is where most people get lost. Imagine you're at a poker game, and one player keeps secretly adding chips to their stack while removing chips from everyone else's. That's essentially what currency manipulation looks like in the economic world. A country artificially weakens its currency to make its exports cheaper and more attractive to foreign buyers, while simultaneously making imports more expensive for its own citizens. The mechanics are surprisingly straightforward. Central banks can print more money, flooding the market and driving down the currency's value. They can also intervene directly in foreign exchange markets, buying massive amounts of foreign currency to push down their own. It's like creating an artificial discount on everything your country sells to the world. Now here's where it gets interesting. For years, the primary accusation against China was that they were keeping the yuan artificially weak through exactly these methods. American politicians from both parties pointed to China's massive trade surplus with the United States as evidence. The logic seemed bulletproof. If Chinese goods were flooding American markets while American goods struggled to penetrate Chinese markets, surely China must be cheating somehow. But when you actually examine the Treasury Department's methodology for determining currency manipulation, something fascinating emerges. The Treasury uses 3 specific criteria to identify currency manipulators. First, a country must have a significant bilateral trade surplus with the United States, exceeding $20 billion annually. Second, they must have a material current account surplus, meaning they're consistently exporting more than they're importing globally. Third, and this is the crucial part, they must be engaged in persistent, one-sided intervention in foreign exchange markets. Here's where the story gets really interesting. While China clearly met the first 2 criteria for many years, the evidence for the third criterion tells a completely different story. According to Treasury reports spanning the last decade, China has actually been doing the opposite of what you'd expect from a currency manipulator. Let me paint you a picture of what's actually been happening. Starting around 2014, something remarkable occurred in Chinese currency policy. Instead of artificially weakening the yuan, Chinese authorities began intervening to strengthen it. They started selling dollars from their massive foreign exchange reserves to prop up the yuan's value. This is the exact opposite behavior you'd expect from a currency manipulator. The numbers are staggering. Between 2015 and 2016 alone, China's foreign exchange reserves dropped by nearly $800 billion. That's not the behavior of a country trying to keep its currency artificially weak. That's the behavior of a country desperately trying to prevent its currency from falling too far. But why would China do this? The answer reveals the complexity of modern currency relationships. As China's economy matured and its citizens became wealthier, maintaining an artificially weak currency became increasingly counterproductive. A weak yuan made imports more expensive, contributing to inflation and reducing the purchasing power of Chinese consumers. It also made it harder for Chinese companies to invest abroad and acquire foreign technology and resources. Moreover, China faced massive capital outflows as wealthy Chinese citizens and companies sought to move money overseas. An artificially weak currency would have accelerated these outflows, potentially destabilizing China's financial system. So Chinese authorities found themselves in the unusual position of supporting their currency rather than suppressing it. This creates a fascinating paradox. The very period when accusations of Chinese currency manipulation reached their peak was actually the period when China was doing the least currency manipulation in decades. It's like accusing someone of speeding while they're actually hitting the brakes. But here's what makes this story even more complex. The Treasury Department's reports consistently acknowledged these facts, yet the political rhetoric rarely reflected this nuanced reality. Report after report noted that China was not meeting the intervention criterion for currency manipulation, yet the accusations persisted. This disconnect reveals something crucial about how economic narratives develop and persist. Complex economic relationships get simplified into political talking points, and once those talking points take hold, they develop a life of their own, regardless of what the underlying data actually shows. Let me give you a concrete example of how this plays out. During the trade tensions of recent years, China was formally designated as a currency manipulator, but this designation was based more on political considerations than economic evidence. Within months, the designation was quietly removed when it became clear that the economic criteria weren't being met. But the damage to public understanding was already done. Surveys consistently show that most Americans believe China manipulates its currency, despite Treasury reports indicating otherwise. This isn't necessarily anyone's fault. Economic relationships are incredibly complex, and political messaging naturally simplifies complex issues. Now, let's dig deeper into what the actual data reveals about currency movements between the dollar and the yuan. Over the past decade, the yuan has actually strengthened significantly against the dollar during periods when you'd expect manipulation to push it in the opposite direction. From 2010 to 2014, the yuan appreciated by nearly 15% against the dollar. That's not what you'd see if China were systematically manipulating its currency downward. Even more revealing is what happened during periods of economic stress. When global markets became volatile, the yuan often strengthened rather than weakened, suggesting that market forces and policy interventions were working to support the currency rather than suppress it. This brings us to a crucial point about currency relationships that most people miss. Modern currency values are determined by an incredibly complex interplay of factors: interest rate differentials, economic growth prospects, political stability, trade flows, and investor sentiment. No single country, no matter how large, can completely control these forces. China's economy is now so large and integrated with the global financial system that attempting traditional currency manipulation would be like trying to change the course of an ocean liner with a paddle. The forces involved are simply too massive and complex. But here's where the story takes another interesting turn. While China may not be manipulating its currency in the traditional sense, it certainly engages in currency management. The distinction is crucial. Currency management involves responding to market forces and economic conditions to maintain stability, while currency manipulation involves artificially distorting those forces for competitive advantage. Think of it like driving a car. Currency management is like steering to stay in your lane and adjusting your speed for road conditions. Currency manipulation would be like using illegal modifications to give your car an unfair advantage in a race. Both involve controlling your vehicle, but one is legitimate and necessary while the other is cheating. Chinese authorities do intervene in currency markets, but the evidence suggests these interventions are primarily aimed at maintaining stability rather than gaining competitive advantage. When the yuan faces severe downward pressure due to capital outflows or economic uncertainty, Chinese authorities intervene to prevent a disorderly decline. When the yuan strengthens too rapidly and threatens export competitiveness, they might intervene to slow the appreciation. This kind of currency management is actually quite common among major economies. The Federal Reserve, European Central Bank, and Bank of Japan all engage in policies that affect their currency values. The key difference is whether these interventions are aimed at maintaining stability or gaining unfair advantage. Here's something that might surprise you. Some economists argue that Chinese currency management has actually benefited the global economy. By preventing wild swings in the yuan's value, Chinese authorities have helped maintain stability in global trade and financial markets. Imagine if the world's second-largest economy allowed its currency to fluctuate wildly based on every shift in market sentiment. The resulting volatility could destabilize global trade and investment. But this raises an important question. If China isn't systematically manipulating its currency, why do trade imbalances persist? This is where we need to understand that currency values are just one factor among many that determine trade flows. Trade imbalances reflect fundamental differences in savings rates, consumption patterns, economic structures, and comparative advantages. China has historically had very high savings rates and relatively low consumption, leading to persistent trade surpluses regardless of currency values. Meanwhile, the United States has had relatively low savings rates and high consumption, leading to trade deficits. These imbalances would exist even if currencies were perfectly fairly valued because they reflect deeper structural differences between the economies. Addressing them requires looking at domestic policies around savings, consumption, investment, and economic structure, not just currency values. This brings us to a crucial insight about modern international economics. In our interconnected global economy, simple explanations for complex phenomena are usually wrong. The relationship between currency values, trade flows, and economic outcomes is incredibly complex and can't be reduced to simple narratives about cheating or manipulation. Consider the semiconductor industry, which has become central to trade tensions between the United States and China. Chinese demand for semiconductors isn't driven by currency manipulation, it's driven by the country's massive electronics manufacturing sector and growing technology industry. Similarly, American semiconductor companies' competitiveness isn't primarily determined by currency values, but by their technological capabilities and access to cutting-edge research and development. The Treasury reports consistently acknowledge this complexity, noting that currency values are just one factor among many affecting trade relationships. But this nuanced understanding rarely makes it into political discourse or media coverage, where simple narratives are more compelling and easier to understand. Here's what's particularly fascinating about the currency manipulation debate. It reveals how economic perceptions can become divorced from economic reality. Despite Treasury reports consistently showing limited evidence of systematic Chinese currency manipulation, polls show that most Americans believe China manipulates its currency. This isn't necessarily due to ignorance or manipulation. It's a natural result of complex economic relationships being filtered through political and media systems that favor simple explanations. This has real consequences for policymaking. When public understanding of economic relationships is based on outdated or oversimplified narratives, it becomes harder to develop effective policies. Resources get allocated to addressing phantom problems, while real economic challenges go unaddressed. For example, if the primary focus is on currency manipulation that isn't actually occurring, policymakers might miss more important issues like technological competition, supply chain vulnerabilities, or structural economic imbalances. It's like trying to fix your car's engine by adjusting the radio because you heard a strange noise. Let's talk about what this means for ordinary Americans. The persistence of currency manipulation narratives affects everything from trade policy to investment decisions to consumer prices. When trade policies are based on misconceptions about currency manipulation, they can lead to ineffective or counterproductive measures that ultimately hurt consumers and businesses. Take tariffs, for example. If tariffs are imposed to counteract supposed currency manipulation that isn't actually occurring, they simply raise prices for consumers without addressing any real competitive imbalance. It's like taking medicine for a disease you don't have. At best, it's ineffective, and at worst, it causes harmful side effects. But here's something interesting that the Treasury reports reveal about the broader global currency system. While individual instances of currency manipulation may be less common than commonly believed, the entire system of floating exchange rates creates its own complexities and potential for manipulation. Countries can engage in what economists call competitive devaluation, where multiple countries try to weaken their currencies simultaneously to boost exports. This can lead to a race to the bottom that ultimately hurts everyone. The challenge is distinguishing between legitimate monetary policy and competitive devaluation aimed at gaining trade advantages. The European Central Bank's quantitative easing programs, for example, had the effect of weakening the euro and boosting European exports. Was this currency manipulation or legitimate monetary policy aimed at combating deflation and stimulating economic growth? The Treasury reports suggest it was the latter, but the distinction isn't always clear-cut. This brings us to one of the most important insights from analyzing Treasury reports on currency manipulation. The global currency system is inherently imperfect, and accusations of manipulation often reflect broader tensions about trade imbalances and economic competition rather than specific currency interventions. The reports consistently show that most major economies engage in some form of currency intervention or monetary policies that affect exchange rates. The key question isn't whether countries influence their currency values, but whether they do so in ways that are transparent, economically justified, and consistent with international norms. In China's case, the evidence suggests increasing transparency in currency policy over the past decade. Chinese authorities have provided more information about their intervention activities and policy objectives, making it easier for other countries and international organizations to assess whether their actions constitute manipulation. This transparency has revealed something interesting. Chinese currency interventions have often been aimed at preventing excessive volatility rather than maintaining any particular exchange rate level. During periods of rapid yuan appreciation, Chinese authorities have sometimes intervened to slow the pace of change, but not necessarily to reverse it entirely. This nuanced approach to currency management reflects the reality of managing the world's second-largest economy. Sudden changes in currency values can disrupt trade relationships, destabilize financial markets, and create economic uncertainty that ultimately hurts everyone involved. But here's where the story gets really interesting from a policy perspective. The Treasury's evolving approach to assessing currency manipulation reflects a growing understanding of these complexities. Recent reports have placed greater emphasis on transparency and communication rather than simply looking at intervention levels. This shift recognizes that in the modern global economy, currency relationships are too complex to be managed through simple rules or accusations. Instead, what's needed is ongoing dialogue, transparency, and cooperation between major economies to maintain stability and prevent competitive devaluations that hurt everyone. The reports also reveal something important about the role of market forces in determining currency values. Despite occasional interventions by central banks, market forces remain the primary drivers of exchange rate movements over the long term. No country can indefinitely maintain an exchange rate that's fundamentally inconsistent with underlying economic conditions. This is why accusations of systematic currency manipulation need to be evaluated carefully against actual market evidence. If a country were really engaging in large-scale currency manipulation, you'd expect to see consistent patterns in both intervention data and market outcomes that persist over time. In China's case, the Treasury reports show that currency intervention patterns have varied significantly based on economic conditions, sometimes supporting the yuan and sometimes allowing it to weaken. This variability suggests policy responses to changing conditions rather than a systematic manipulation strategy. So, what does all this mean for understanding global economic relationships? The currency manipulation debate reveals several important truths about modern international economics. First, simple explanations for complex economic phenomena are usually incomplete or misleading. Second, political narratives about economic relationships often persist even when they're contradicted by evidence. Third, effective economic policy requires understanding nuanced realities rather than relying on simplified talking points. The Treasury reports on currency manipulation provide a fascinating case study in how economic analysis can reveal the complexity behind seemingly straightforward issues. They show that accusations of currency manipulation need to be evaluated based on evidence rather than assumptions, and that the reality of international currency relationships is far more nuanced than political rhetoric suggests. Moving forward, the challenge for policymakers and the public is to base economic policies on evidence rather than narratives, and to recognize that in our interconnected global economy, simple solutions to complex problems are usually illusions. The currency manipulation debate offers important lessons about the need for nuanced understanding of international economic relationships and the dangers of basing policy on outdated or oversimplified assumptions. Understanding these complexities isn't just an academic exercise. It affects everything from trade policy to investment decisions to the prices you pay for goods and services. When we get these relationships wrong, everyone pays the price through ineffective policies and missed opportunities for mutually beneficial economic cooperation. The evidence from Treasury reports suggests that rather than focusing on accusations of currency manipulation, we should be having more sophisticated conversations about how to manage currency relationships in a way that promotes stability and shared prosperity in the global economy.